Okay, class, it's Sunday night. So I'm going to see if I can shoot this video and the same time as and put it up here on the board for you. So, problem 57 is about qualifying small business stock. Okay? And the magic of qualifying small business stock, if you'll remember that if I sell stock at a loss, if I still sell some type of capital asset at a loss, I'm limited to my capital gains plus an additional $3,000, producing a net $3,000 loss. However, if it's qualifying small business stock and I'm single, I can take $50,000 as an ordinary loss. If I'm married, I can take $100,000 as an ordinary loss. Any remaining amounts are capital losses. Okay, so in this problem, I sold 1/3 of my qualifying small business stock of $100,000. And I sold that for $25,000, producing a net loss of $75,000. Okay, of that $75,000 loss, I can take $50,000 as an ordinary loss and my $3,000 capital loss. So I started off with a $75,000 loss. I took $50,000 as this, we're going to call it Section 1244 stock, as a Section 1244 stock loss, and $3,000 capital loss in the year of sale, giving me a carryover of $22,000. In the next year, I had a $12,000 gain. So again, $12,000 gain. I'm going to be able to take $15,000 of my capital loss and again producing a $3,000 capital loss then in the next year, and this now reduces my carryover to $7,000. In the next year, I have a $4,000 gain, 16 minus the 12, plus then this additional $3,000. So I'm going to use $7,000 here, using up all my capital loss. And this again produced a $3,000 capital loss then in the third year. Okay, problem 59. Remember back in chapter 2, we had this arm's length transaction concept. And what the arm's length transaction concept said is if you sell property at a loss to somebody that's a related party, that loss is non-deductible. However, if you sell at a gain, that gain is taxable. Okay, so there's one additional thing is that the related party I sold this stock to, the initial transferee can reduce whatever gain they have by the previously disallowed loss. And so that's what we're going to do in problem 59. So in problem 59, purchased 3,000 shares of stock for $9,000. Sells 200 shares to her brother John for $3,600. So we're going to take 2/3 of the $9,000 or $6,000 basis. sold it for $3,600, gives me a loss of $2,400. And this loss, because it's sold to a related party, is non-deductible. Sells the other that has a base of $3,000 for $2,000, producing a loss of $1,000, and that is deductible. All right. Part B. Assume John sells the stock for $4,800. What impact does the sale have on his and Caitlin's 2020 taxable income? It will never have an impact on Caitlin's, but it will have an impact on John's. So John now sells it for $4,800. This is part B. Sells it for $4,800. He originally purchased it for $3,600. Gives him a $1,200 gain. But John can reduce that gain by the previously disallowed loss. Now, the previously disallowed loss was $2,400, but he can't use all $2,400. He can only reduce the gain to zero. So he's going to take $1,200 of this previously disallowed loss to produce a gain of zero. Okay, part C. John now sells this for $6,200 minus $3,600 produces a $2,600 gain. Remember, Caitlin's previously disallowed loss was $2,400, so he's going to be able to reduce this by $2,400 to produce a net gain then of $200. Now, in part D, sells it for $3,100. So we're going to again take this $3,600 minus the 31 sales price gives us a capital loss now of $500, and this $2,400 previously disallowed loss ends up in the same place as Sam's goldfish, flushed down the toilet, never to be seen of again. All right, that's problem 59. Okay, so now with the work we did in 59, I'm just going to talk you through 60. So Elliot now has a $2,000 loss because it sold to his sister. He cannot deduct it. But when Nancy sells the stock for $7,000, so he has a total gain of $3,000. The $7,000 minus the $4,000. Nancy's going to be able to reduce that $3,000 gain by the $2,000 previously disallowed loss to produce a net gain of $1,000. In part B, Nancy's going to have a $1,000 gain. Going to be able to reduce that $1,000 gain by $1,000 of the previously disallowed loss to produce no gain. And in part C, Nancy's going to have a $2,000 loss, and the $2,000 previously disallowed loss is gone forever. All right, so that's 60. Okay, students, problem 62. Problem 62 deals with a concept called wash sales. And what wash sales are sales in which I sell and then reacquire the same stock either 30 days before or 30 days after the sale. You can imagine the incentive that I would have if I have some stock that's gone down in value. You can imagine the incentive I would have to sell that stock at the end of the year and reacquire it at the beginning of the following year if I think it's a good stock and it's going to get better. Well, because of that opportunity for to get losses that are not really losses, because if I reacquire it, it's not a true loss. Those are wash sales. And wash sales, first of all, only apply to losses, don't apply to gains. So if I have a wash gain, that's still fully taxable. So these wash sale rules only apply when I have a loss. And basically what happens is the loss that I have then gets added to the basis of these wash sale shares that I had previously, that I acquired then, that falls within this 30 days before, 30 days after time frame. So here what we have is we have now shares, 500 shares that I bought for $20,000 that I sell for $12,000 to produce an $8,000 loss. I then acquire those same shares within 30 days. And what I did is I basically now have to put these shares into two different groups. I have this 500 shares, which are my wash sale shares. And I have 100 shares that we're going to just call them new shares. Wash sale shares don't apply because it was only 500 involved. Now, when I do the math on this, is I take this $15,000 that I purchased them for, divided by 600 shares, times 500. Okay, so 15,000 divided by 600 times 500 gives me $12,500 is how much I paid for these wash sale shares, plus the $8,000 previous loss, gives me a basis now of $20,500 now in these wash sale shares. Of these 100 new shares at $25 a share, that gives me $2,500 basis in those new shares. So now when we sell these, it looks to me like the sales price is about $36.67 a share. So that's what we're going to use. When we take this $36.67 a share times 500 shares, we get 18,335 is my sales price, producing a loss of $1,165. When we do the same thing, the 36.67 for these new shares with a base of 2,500, that gives me a gain of $1,167. This is a long-term capital gain, and this is a short-term. This is a long-term capital loss. This is short-term capital gain. And there we now have the application now of the wash sale rules. Okay, problem 64 is an easy problem. And the reason it's an easy problem is there are two ways that we can account for stock sales. Is one way we can do is specific identification. We call up our broker and we say, "Hey broker, sell the shares that I purchased on this specific date." And we would use then that sales price of those shares, and we would use as basis how much I paid for those shares that I purchased on that specific date. If I do not do that, then we use a FIFO flow, first in, first out. Now here what I did is I purchased 300 shares. I then bought an additional 200 shares. I then sold 300 shares. Okay? And none of this happens within this 30-day before, 30-day after, so wash sale rules don't apply. And so I sold 300 shares, which based on a FIFO flow would be those 300 shares I purchased in 2017. So I would take my sales price of $5,400 minus my purchase price. Actually, stop that. I realize that this is a wash sale problem. So let's go ahead and treat this as a wash sale problem. Sorry about that. Those ideas of first in, first out versus specific identification, those are tax rules, but there's a 2-week sale in here, so that this is a wash sale problem. So just a second. Okay, class, let's try 64 again. So we need to set this up. So in 2017, I purchased 300 shares at $21.67 a share for a total of $6,500. In 2019, I purchased an additional 200 shares at $24 a share for a total of $4,800. Okay. Then in 2019, again, this wash sale rule, I sold 300 at $18 a share for $5,400. Well, only 200 of them are wash sale shares. It's these right here. So I'm going to take these wash sale shares, this 200 at 24 for $4,800, and 200 at 18, which is $3,600, to produce a loss of $1,200. Now this loss is non-deductible, gets added to the other shares that I own. Okay, everybody following me so far? In addition to that, I have 100 shares that are not wash sale shares. So I sold 100 at $18 a share, $1,800. And those are shares that I purchased for $21.67. So 100 at $21.67 gives me $2,167 for $367 capital loss, and that is deductible because those 100 shares are non-wash sale shares. So now what I have now is these 200 shares left here. So I take 200 times my 2167, which gives me $4,333, plus this $1,200 from this loss, this wash sale loss that gets added to basis, to give me a total of 55.33 now, basis now in the 200 shares that I have left. All right, that's kind of a fun little problem. Sorry about the misdirection to begin with, but that is the solution now for problem 67. Sorry, not 67. That is a solution for problem 64. Okay, problem number 67. Problem number 67 actually is pretty easy at this point with the change in law that happened beginning 2018. Remember, on a business casualty loss, my deduction is equal to the lesser of my adjusted basis or decline in value if it's partially destroyed, or my adjusted basis if it's destroyed. And I'm going to take those amounts minus whatever insurance recovery I get. So, in part one, remember in case A, my building is a business, my automobile is personal. My personal casualty loss I can only take if it's a federally declared disaster area. Here it doesn't give us that indication. So in part A, my decline in value is $45,000. My adjusted basis is 60. So I'm going to take 45,000 minus my $36,000 insurance recovery to get a $9,000 casualty loss. In part B, where it's completely destroyed, I get insurance reimbursement of $130. My basis is 60. So in part B, I actually have a casualty gain then of $70,000. And again, the automobile in both those situations. There is no personal casualty loss after 2018. Okay, class. Problem 69. I just want to work through problem 69 with you. I'm not going to put this on the board. 20,000 shares of qualified small business stock lost $62,000, phase single. So she's going to be able to deduct $53,000. $50,000 is an ordinary loss. $3,000 is a capital loss. The next one, 1,200 shares at a gain of 4,500, bought the stock in 2016. This is going to give me a long-term capital gain of $4,500. My sailboat was personal in nature. Remember, I cannot deduct losses on sales of personal use assets. Therefore, the sales boat is non-deductible. Part B, however, I had a gain on a personal use asset. Gains on sales of personal use assets, however, are taxable. And so that $3,700 gain is going to be taxable. The 50 shares sold for $1,300. Even though it's to a delayed party, remember losses are not recognized, but gains are. So going to recognize the gain of $1,300. And here, this $300 loss, because she sells it to her sister, is going to be non-deductible. All right, and problem 73. Problem 73 is really about If I have losses, do I materially participate, and are those losses deductible? It looks to me like working 40 hours a week meets the material participation tests of either 500 hours or 100 hours, and it's more than anyone else, so going to materially participate. Not going to be a passive loss, and it's video game software and movies. So those are things that require significant personal services. So it's not going to be passive because of Trental, and so going to be able to deduct any losses that they have. And with that, there's the end of chapter 7. We'll start on chapter 8. And I'll upload that video tomorrow night or first thing on Tuesday morning. Good night, be safe, and I'll talk to you later. Bye.